Phil McCoy from Ameriprise Financial and the Mirius Group of Financial Advisors, Winchester Avenue, Martinsburg. Good morning, Philly.
Good morning, guys. How are you all?
We just had a robust debate in the last half hour about the whole Iranian situation. And while you're with us, Phil, it gives us an opportunity to get the financial aspects of the ramifications of this. And as we speak, the Dow is down 0.1%. The S&P is pretty much flat. The NASDAQ is pretty much flat. The price of oil this morning is higher. Not as much as you'd think, though. It's up just 8 cents a barrel at $73 and what is that? 62 cents, 92, 73.92. On Friday, late last week, I think it hit $76 a barrel at one point. So, Phil, this is fascinating to me that oil is not more expensive today than what it is.
I think some of this is priced in, and this is so early on in this entire ordeal that if I had to place a word on what does this mean, I would say, well, it's offsetting. There's a few things that this can mean. Number one, it does, although I'm not trying to insinuate that the events will assist in good market performance, but it does remove some uncertainty because we went all of last week wondering what our response would be, and now we know what our response is. We found that out over the weekend. But the offsetting part is it does have an impact, and at the moment we know that one of our big market headwinds over the last few years has been inflation, and of course the price of oil going up would impact that. So early on in this entire thing, it is offsetting. There's a part of it that kind of says, okay, the market is saying, or our money is saying to us, okay, well, now we know what our response would be. Now, the next question is how far does it go? What is Iran's response back to us? And, of course, that the strait that we're concerned that may get choked off, which would, of course, put pressure on oil even more. That's a concern. But we do know what our response would be as we wait for what are other countries' responses to this, and what do they think about it, and who may else get involved. But as of the moment, when you look at the markets, our volatility isn't what you would think it would be over the weekend. And so I would say it's right now offsetting with what it's doing to our markets. It does muddy the waters a bit. We've talked a lot about that with tariffs, and as we get economic reports and economic indicators, inflation in particular, what do the tariffs mean going forward? Now we just have to throw this in with it as well, with this unrest with the Middle East. What will that mean moving forward as well, and how do we decipher that? And it's not necessarily how we decipher it. The most important part of it, again, you guessed it, the Federal Reserve, how do they decipher it, and what, if any, action may they take? And this isn't the same thing, but I'll rewind back to a few years ago where we were getting ready to increase rates, and Jerome Powell got a lot of heat for this. But Russia invaded Ukraine, and his response, the Federal Reserve's response, was to slow down a bit. We don't want to increase rates at a huge clip in the face of this. So it kind of blunted their movement and made them very late to the game in rate increases to slow our economy down. And so what, if anything, will this mean to Jerome Powell? So as far as the economy is concerned, their policy and what they may do, we'll eagerly await to see if there's any word coming out of the Federal Reserve, if it means anything at all to them at the moment. But there's a lot to absorb with this and what it may mean for our stock markets. But early on, I'll repeat it, it's offsetting.
I think one of the reasons it hasn't affected the markets that much is because not a lot has changed. You know, we dropped a couple of really big bombs into a war that's been going on for quite some time. So the threats on the Straits of Hormuz and all those are actually easily cleaned up. We have stuff to do that with. So my guess is the reason the markets aren't reacting badly is because nothing other than dropping a lot of bombs, big bombs on some facilities. The situation on the ground in Iran and in between Israel and Iran really hasn't changed.
Well,
it's just kind of a continuation.
In regards to the price of oil, I think, Phil, your point early on was it's already been priced in. We've had a 20% run-up in the price of a barrel of oil over the last, month? It was 61 something a barrel maybe 2-3 weeks ago, and now it's $74 a barrel. So that's about a 20% increase. So clearly there was some anticipation of something was going to happen, and it happened. And now we'll see. I guess the next part of that, Phil, will be if there is some type of retaliation or choke off of oil in the supply chain, that might be the next bump in the price of oil.
If it actually occurs, and you're right. So as this occurred over the weekend, I don't know that it was surprising. I don't know that any moves were shocking and unexpected. So a lot of that was kind of baked in. That unrest was there anyway. And yes, that would be the next step. There's a lot of people that think that this is going to bring an end. This could actually help bring an end to some of that the oil shortage, and there'll be some sort of resolution fairly quickly because of the amount of force and how quick it was, and our response to their issues with Israel. But all of this was kind of expected. Of course, we didn't know exactly what would happen, or money didn't know exactly what was going to happen, but it wasn't a surprise. As we saw that, I don't know that it was shocking to anyone that was paying attention that was our response. So that's kind of why I say, like you said, the price of oil didn't jump as much as what you would think. It's because it's kind of already happened. It was baked in a way.
Phil, this is John Doyle. If we could move a little sideways here, on the tariff question, what's your view of where it is now and where it's going, and what the effect is going to be once it settles out? Our tariff negotiations or disputes, whatever you want to call them, with all kinds of different countries.
Now, a lot of opinions are going around tariffs, and I'm of the belief, as a lot of people are, especially some of the economists that we're listening to. It's not necessarily, the tariffs have been a headwind, for sure. They have been a headwind, as evidenced by early April and those 3 days after Liberation Day. So they have been a headwind for the market, but it's not necessarily the existence of tariffs that is the headwind. The headwind is not knowing what the tariffs are going to be and how severe they are. So, and I would maintain, I have a really, really, really smart client that disputes this harshly, but tariffs turn into a consumption tax in our view. So at the end of the day, tariffs are a consumption tax, and I think we can accept that. We can accept the consumption tax, or money will accept that, as long as we know what they are and how to prepare for those. And a lot of this theory comes from, if you go back to Liberation Day, the first 10 to 15 minutes of that speech was centered around 10% tariffs and a flat tariff on everyone. It was like, okay, it's 10%. It was really simple at the very beginning of that speech, and then out came the chart, and it's like, however, here are the non-bearer carrier countries, and this is what our retaliation, or response, I should say, would be to what we believe that they're placing tariffs on us, and those were all over the place. So in that 20 to 30-minute time frame, that was after the close on April 2nd, I believe the day was after the close, our markets on the 10% tariff across the board, when it did sound that, hey, this is going to be it, our markets went up. S&P, I think, went up over 4% fairly quickly in aftermarket trading, or after-hours trading. And then the chart came out and was like, whoa, wait a minute. This is confusing. This is all over the place. And as everyone started to absorb that, it quickly turned to 4% down. That was a crazy change in the amount of 30 to 45 minutes. And I would maintain that it's not necessarily that tariffs exist. I don't think that the existence of tariffs themselves that we're placing on other countries is what has been painful to our markets. It's the uncertainty of what they are. Now, as time has gone on, we've seen recovery from our markets, and although we're still not quite sure what they are, but what it is fairly certain is they're not going to be as bad as what that chart was when they first pulled that off, and the willingness to move off of those or negotiate some of those down, especially as it hurt large corporations in the United States. Ford is a great example of that, where Ford CEO had went to the administration and said, hey, look, we can't deal with this. as it pertains to these semiconductors in our vehicles, and the administration's like, oh, okay, you can't deal with it. We'll pull that off right now. So that willingness to come off of some of those in response to some of our own companies has kind of helped the markets. We don't know what they're going to be, but we know they're not going to be as bad as what that chart said.
Is it possible that we're not seeing the market react in terms of tariffs because tariffs are no longer leading in the news? There's not a drumbeat of
Yes.
We're going to be run into this horrible situation, and that as the tariffs quietly fall into place because they're not leading the news, the Americans don't react in that panic mode of selling off. You think that could be part of the issue?
Yeah, and there's part of it that it's not the headline, right? Because we've got this unrest in the Middle East, and it's no longer the headline. We've had the tax bill now that's coming out, and there's a lot of different opinions about the one big beautiful bill and what it would mean. There's a ton of opinions, all of which have validity to them, but a ton of opinions on what it could or could not do for our economy. So it's the tariffs have kind of taken a back seat, and in a way, we've kind of become accustomed to hearing about them so much that we take it with a grain of salt, and maybe we don't take everything that we hear to heart and know that it's part of the negotiation, and we're not quite sure whether it's going to be. But in the headline, in the economic headlines, what once was just a month and a half ago, you heard every single day there's a deal being made, there's a deal that's falling apart as it pertains to tariffs, has now been replaced with the big beautiful bill, and of course what's going on in the Middle East. And tariffs may be 3 or 4 down the line as far as what the headlines are concerning as it pertains to money.
I want to talk about Powell's eventual decisions on interest rates, Phil, and everything that goes into that, because that's obviously now got to include what the future of oil is in terms of its price and how that affects inflation. Yet he still did commit to 2 interest rate cuts before the end of the year. I'm curious as to why you think he committed to that when he clearly doesn't have all the information yet to be able to make such a decision, nor does the entire Fed board.
Well, I would think I wouldn't use the word commit. I think predict that is what would be necessary. But at the end of the day, we have to recognize that what the Federal Reserve is doing is trying to predict what all of these will look like, because all these economic indicators will look like. Inflation and jobs, most important, employment and inflation are their 2 mandates. But as they make these moves, they don't want to be late again, because they were late, admittedly so. They were late on rate increases before, and then had to be very drastic in their movements. But they're trying to predict what is around the corner, and they're doing that by trends. They're doing that with a lot of these economic indicators that we don't even pay attention to, that they are paying very much attention to, and coming up with a prediction, just like our stock markets are doing, where we're trying to predict something based off where we currently are and what we think all these things that are going on, tariffs, Middle East, the big beautiful bill, all these things, what it could mean for our economy. So they're doing the same thing. They just should be much, much better at it, and they are much, much better at it than what we on the street are at predicting. So they're trying to predict those things, even in the face of some of these inflationary headwinds that will most assuredly always be there. But the worst thing, what they want to avoid at almost all cost, is overall deflation. We've talked about that a lot before. That overall deflation. Now, it's okay for one thing to deflate in prices. Our grocery prices to deflate, that's okay. Or our insurance to deflate, that's okay. But when you look at the overall picture, if we're in a period of deflation, that's very, very hard. It's very difficult for the Federal Reserve to turn that around or have any impact to turn that around. So they of course, want to avoid that. They're walking a tightrope. So they'll make those moves in advance of, and hopefully, unlike when they had to increase rates, small incremental moves that won't have a drastic impact. They can see, okay, we turned that dial a little bit. Now let's take a step back. They did that in the fourth quarter of last year. They turned that dial a little bit. Now let's see what the impact of that is. Now do we need to leave it here, turn it back, and we haven't really discussed that yet, turn it back or crank the rates up a little bit or can we continue with these slow, predictable rate drops that we're doing? So they're trying to predict and act in advance of some of these issues that we could run into in the future, one being a recession.
But shouldn't
act in advance of that.
A certain amount of deflation be necessary and welcome after a period of higher than usual inflation? And I'll give you my reasoning on this is inflation got blamed on a couple of different things. One, the money supply, of course, but two, the price of fuel was higher, and everybody who delivered anything to a supermarket or a store said, oh, well, the price of fuel is so high, I've got to raise my prices to keep up with the price of fuel. Well, gasoline prices, even with this most recent increase, are still much lower than they were last year at this time. And then the other thing was the labor supply. Well, there aren't enough people who want to work, so we've got to raise the price of wages. That drives up the cost of goods. That's not a thing that we're hearing about so much anymore. So with some of those major contributors to inflation now no longer being a factor, shouldn't there be some deflation?
We want deflation in certain areas, but we don't want overall deflation. So, and what you just brought up, deflation in oil prices or gas prices, yes, that's welcome. Deflation, that which then, of course, brings about deflation at the grocery stores. That's also welcome. But as far as wages are concerned, they're not deflating. They're just not inflating as quickly. So there's still wage inflation. It's just not nearly as quick as what it was before. And then when we look at some of the cost of goods and services that we bring in, or I should just say goods, that we bring into our country, what does that look like? What's the impact of tariffs on that? So if you look at the overall CPI, PPI, or PCE, there's a ton of different categories in there, and some of those will deflate. Some of those individually will deflate, and that's helpful. The price of used cars, which has so much of an impact really on the overall inflation picture that I really didn't realize it until it was a problem. And you look at the price of used cars, which in turn brought up the cost of insurance. So most American homes have cars and insurance, of course, and so it's costing everyone so much more money than what you would think that one little sector would mean. That's welcome. Yes, let's bring back down the price of cars or automobiles used in new boats. Let's bring some of those down. New cars rarely drop, but used cars will. So in a lot of us, that's how we buy our vehicles is secondhand. But that had a huge impact. I really didn't recognize how much the price of used vehicles played in overall inflation. But that's okay. You let that deflate. We just don't want all of those to deflate at the same time. It kind of brings on the Black Friday effect that economists talk about quite often. That's why these Black Friday sales or Christmas specials have ran all the way back into July now, because they're trying to head off this period where consumers won't buy anything on the perception that it's going to be cheaper later. And that's what the overall in deflation, if you took everything and deflated it at one time, it makes consumers grab a hold of their purses and hold on tight and not spend anything on the perception that it's going to be cheaper later. Now, you can't do that with groceries, and you can't do that with perishable items. You can't do that with insurance, except for people shopping insurance. But overall, the economists do not want to see deflation in every category.
Phil, this is John Doyle. It's my recollection, correct me if I'm wrong, that the last time we had a period of overall deflation in this country was during the Great Depression. Is that right?
I think we had some, yes, and I think we had some, and I'd have to go back and check my answers, but I think there was a period in the 70s where we hit that as well, but it wasn't long-lived, and I'd have to go back and check that. That's old school financial Phil getting educated. I don't remember the date, but it doesn't happen. It doesn't happen often, and it's not something we think we want to see that. And maybe as a consumer for a moment we want to see that, but really what we want is just to see some of these items that we're interested in that impact our own lives. We do not want to see overall deflation. That also leads to wage deflation as well. We certainly don't want to see that.
Yeah.
Mr. Gilstrap, did you have a question? If not, I'll have one.
Go ahead. I just have a hard time wrapping my head around the harm of large-scale deflation.
Prices coming down?
Yeah, and I'm not an economist, obviously, but just trying to imagine in my head, I understand the harm of inflation because everybody has to spend more money. I'm not seeing the harm of
Phil, what's
deflation.
the harm of deflation?
Well, it will go back to this Black Friday effect, and that's maybe a name that I've given it. But if we all recall, the Black Friday, the sales on Black Friday, it's even kind of become a holiday, and now Scrooges like myself will complain that Christmas starts too early and Christmas sales are coming on too early. So a little bit of research will tell you that the reason that occurs is because retailers are trying to avoid this black hole of no one buying anything leading up to Black Friday, because the overall perception that prices are going to drop on Black Friday. So they say, hey, we've got to replace this with something. And now there's a million different types of days trying to fill those black holes to encourage people to purchase something before that huge sale day. So now there's always a sale going on all the way back. We'll have one coming up here shortly in July, where I forget what we call it, but there's something in July that's Prime Days or something. But it's angled around this whole Black Friday that's prices are cheaper in the future.
That's retail stuff, right? I mean, that's bread and cameras and stuff that you buy. But writ large, if steel becomes less expensive, it seems to me that people will build more things. Mm-hmm. And I see that, to me, that rings as a positive thing. I mean, I don't want to turn this into an economics class, but it just the statement is, I'm having a hard time understanding how this works.
To separate a certain item becoming less expensive, say bananas or steel or used cars or auto insurance, opposed to every single thing that we purchase or every single thing that we use becoming less expensive. And it sounds great as a consumer. Consumer Phil loves that, and the dad in me loves that, because I have one teenage daughter and one in her early 20s. But financially, as far as companies making money, it causes consumers to not be willing to spend on the perception that everything is going to be cheaper later. And that's all. The whole premise of it is everything can't fall at the same time, and if it does, it's a bad thing.
Phil, before we go, there is a story that was out. Apple is facing a proposed securities fraud class action lawsuit filed by shareholders who claim the company misled investors about its progress in integrating advanced AI into Siri, which they allege harmed iPhone sales and the stock price. It's a suit filed in the San Francisco federal court. It names Tim Cook, the finance chief, and the chief financial officer as well. Are these common lawsuits by shareholders who feel like they've lost value in their share price because the company was not fully truthful about statements?
It's not uncommon, and you'll get that a lot, and that's why we take to heart so much when we talk about earnings and forward-looking guidance from companies. They're held responsible for what they let the investors know. It's not. I wouldn't say that it's necessarily common, but it's not uncommon, if that makes sense. So it's not uncommon that shareholders would come forward with some sort of suit like that, and some sort of a settlement would be made. And that's why a lot of investors, Ameriprise and other places, they complain a lot when they get a lot of the letters in the mail that says, hey, I'm part of this suit, or I'm part of this, or I'm part of that, and I don't even know what it's talking about. That's where it comes from. So it's not necessarily uncommon in that the one you had just referenced, I hadn't even heard of yet. It hadn't even crossed their desk. But it is fairly normal that we see that happens.
Are they often successful?
To some extent, yeah. They'll come up with something, even if it's just to shut the investors up. Sometimes it's cheaper just to shut them up than it is to go through the litigation. How
do we reach you for more information today, Phil?
You can reach us at 304-263-4343, or stop by and see us with an appointment at 1270 Winchester Avenue, right here in Martinsburg.
Thank you, Phil. Have a great day.
Thank you, guys. Much appreciated.
You can catch 2 minutes of Financial Phil each weekday morning at 6:38, replayed at 7:38 for a preview on the day's markets and a recap of the previous day's action this